organization on asset owners such as sovereign wealth funds, pension plans, endowments, foundations. And by the way, this webinar will be available. We are going to record it, so if people cannot make this or if they have issues with the service that we have, it will be available to view, and my staff can send out that link. So just want to get started here, and please, if you have any questions with the performance of the GoToMeeting, you can always email support@swfinstitute.org. That's support@swfinstitute.org. So the purpose of this call is to go over the SWFI Global Asset Owner Survey. This survey, we've done quite a bit of them. This is, I believe, our 11th survey that we've conducted over a period of time. The Global Asset Owner Survey, the goal of it is to really encapsulate what asset owners are feeling about the marketplace, their sentiment, where they see the biggest risks are. And as you know, today, there's quite a bit of volatility in the marketplace. We are in the midst of a bit of panic. Central banks are doing unprecedented moves. We have stock markets freezing up. And as you know, the coronavirus is probably in every little bit of news headline that we're seeing today. So everything we're talking about today is very timely. But as you know, sovereign wealth funds and pension plans are long-term investors. So this will be very interesting to kind of go through this survey and the thoughts of these various investors. Now, to keep things in context here, this survey was conducted between February 2nd and February 29th. So a lot of things have happened since then. So let's just keep that in mind. So there is a bit of things are unfolding now every day, right? And we basically had newer numbers from the coronavirus outbreak, and then we also had the news that OPEC couldn't agree on the oil prices, and that sent a lot of oil companies stocks falling very fast. So let's keep that in mind. So let's just start with the survey here, and we'll kind of go over some of the notes. And by the way, if you are not a subscriber to SWFI, feel free to email support@swfinstitute.org. We operate a platform, an intelligence platform on asset owners. All the research that we do is from the viewpoint of the investor, and some of the highlights I will be showing you here as we proceed. And as also a few other notes here, this survey is a quarterly survey, and so here are timelines of publishing it. And also, just to reiterate, we do exclude asset managers from the survey. So again, you're only getting the allocators, the actual fiduciaries of the funds. And if you are an asset owner on the call or listening to this recorded call, you can always reach out to research@swfinstitute.org. In addition, some of the things that we do is we make sure that we don't have more than 2 people at one investor contact us. So we do have some sort of quality screen to make sure that we're getting a very diverse sample. So I'm just going to scroll down here, and let's start with the first question that's asked is, what do you think is the most crowded trade? And as you look here, again, our survey started in September 2017. Over a period of time, and again, the survey was taken February 2nd through the 29th, that the most crowded trade that our respondents see is long U.S. technology equities. What does that mean? That means buying, Alphabet, which is Google, Netflix, Amazon, Apple, all those stocks. And the other crowded trade is long, high-quality equities. Now, if I'm gonna jump to our system here. So right now, I'm looking at SWFI.com. This is the platform that we have. I'm going to look at Norway's holdings. So I can go to home here, and I can do search, and I'm going to look up sovereign wealth funds. So I'm going to do add a filter, and then I'm going to go to type, and I'm going to type in sovereign wealth fund. Then hit add, apply filter, and then I'm going to select Norway sovereign wealth fund. And I want to look at their holdings, so I'm going to go to holdings right here. And as I mentioned in the survey, a lot of the large wealth funds and a lot of actually pension funds, endowments around the world, because a lot of the stuff is market cap weighted, you'll see that there's a tremendous amount of exposure to technology stocks. And not, technology stocks have been a major driver for returns for these investors. It's something where, if you missed out on this, you're probably shooting yourself in the foot. So, Norway, I believe in their 2019 annual report, they claim to have some $180 to $200 billion worth of returns, depending on your currency translation. And so a lot of that had to deal with the asset allocation of Norway's sovereign wealth fund. And I can go on that right now just to kind of show you asset allocation data, the raw data behind it, that a large portion of their assets are into public equities versus fixed income, and that shift has been occurring quite some time. As you can see here, there's been legislative approval within the sovereign wealth fund to have a higher allocation to equities. And then a kind of a side note here is that they also decreased or slowed down their private real estate program. In fact, there were quite a bit of layoffs within the sovereign wealth fund, and they are now going more towards REIT investments globally. So you'll see the wealth fund pick up those as well. So just kind of showing you there that is a very crowded trade, is the long U.S. technology equities. And so that's kind of been like a theme for many of our respondents ever since we started this survey. And also the long high quality equities. So let's kind of go down here and let's look at the largest driver of listed equity prices in the next 6 months. So we're kind of, these allocators are forecasting, what's going to have the biggest impact on it. Now, this survey, again, filled out in February, this wasn't even a question, coronavirus and pandemic. That was another option. And we actually computed that, and we had 6. So this, if the survey was probably taken this month, I would say this would be the biggest impact driver. So kind of what's taken the cake here is Treasury bond yields. We saw that people flying and fleeing over towards Treasury bonds. The U.S. 10-year Treasury, it basically fell to the lowest level, and that's having a lot of impact on the markets today. The Treasury is looking at ways to increase the liquidity, and also a lot of investors are falling into these money market funds, and the demand for these types of securities are going to be a huge factor. So that's also one of the large drivers of listed equity prices is Treasury bond yields, and then obviously company earnings. So all of these, I feel, are interlinked and related. So a coronavirus pandemic, that is definitely impacting. Oh, please make sure your phones are on mute, please. Thank you. A coronavirus pandemic, that's impacting the earnings of companies, and the earnings of companies, are impacting the stock market. So it's sort of a kind of feedback loop here. But if you, before this pandemic, which seems to be the catalyst of what's happening today, and also not being said is the oil price OPEC thing that's occurring. We see that company earnings has been the biggest driver of returns. And that sentiment was actually in March 2018, Treasury bond yield did beat that. But over 2018, investors were looking at, hey, am I buying stock that's overvalued? That's why the company earnings were really important, not so much of the QE measures. All right, so let's kind of move along here, and let's look at risk. Risk is a very big deal for asset owners. All of our clients are analyzing and trying to have downside risk to these equity markets. So what is the biggest tail risk that investors are seeing? And right down here, we have coronavirus and pandemics at 5, and that was the other category. So we really didn't anticipate that. That will probably be a regular item in our next survey. And the reason why we keep the questions the same, again, we are trying to track sentiment changes. And so before this pandemic catalyst, the main issue that was on everyone's mind was trade wars and increased protectionism. and that was something that a lot of investors were very concerned about, but it still didn't have a very large impact on the overall stock market, as you can see today, right? I mean, the market kept on going up, even though trade wars and protectionism was the largest concern. And so, even with changes in CFIUS, which is that's the law where basically you have to go through extra layers to get deals approved, or it might not get approved. And the CFIUS rules are quite, if you don't know enough about it, there's a lot of information on it, but it definitely impacts cross-border investments and the private equity industry because, well, I can go to that later, but it's definitely has a legitimate impact on large cross-border deals. But that was the prime concern of the biggest tail risk. Stock market bubble, that is one also I do want to highlight as well. Just when is this bull market going to end? I mean, that was pretty much what everyone was saying for quite some time here, is that, do I get out of stocks now and, do I put it all in the bonds? And so this coronavirus has been the catalyst to that. And that's why, you'll see the returns of these sovereign wealth funds and pension plans for 2019. They are quite decent. They're not as, and a lot of that is equity driven. I think the returns for 2020 will not be so well, and there will be changes within these asset owners. Let's scroll down here and we'll look at another question here. With regard to earnings expectations for listed companies, do you think they will improve? And what we mean by improve is will it rise by 10% or more in the next year? Okay. So as you see going on here, we had the tax cuts coming in, deregulation. People were more optimistic, and you can see this change over a period of time. So the optimism kind of faded into the 2019 year. People are like, how good can this get? It has to change here. And we look at the current, only 3 respondents out of 29 think that earnings are going to improve. And right now, we saw Apple, we saw pretty much every major tech company, every manufacturing company, airline companies, manufacturers, cruise line companies, their earnings will not be that great for 2020. And so this is becoming a reality. So the question is, these surveys are very useful, but what are the catalysts that make that change happen? And we think, it's pretty apparent that the coronavirus has been that. Now, how long will this virus last? How long will it be around? We don't know. I mean, I don't know. I'm not an epidemiologist, but what I do know, and what my clients tell me, is that it is having a major impact on, besides the personal pain, it is having a major impact on the airline, travel, tourist industry, and that industry for some countries is a major driver for their governmental budgets. I mean, especially in Southern Europe, parts of Asia, and so that's why in concert we're seeing a lot of the central banks, acting, lowering rates to almost zero, and the talk of negative interest rates is slowly coming true. I mean, it's something that could happen. So let's jump back here. Talking about Bitcoin and blockchain. So in about 2018, we introduced 2 Bitcoin blockchain questions because there was a lot of interest in that area. The interest has dissipated tremendously in blockchain and Bitcoin. And as you know today, and what I wrote in my press release, is that the downturn here is impacting other asset classes. So if people were trying to sell Bitcoin or cryptocurrencies, Bitcoin's tanking right now. Gold, I believe, is tanking right now. So a lot of the investors are going to safe haven assets, treasuries, U.S. dollars, hard currencies, and the interest in Bitcoin and cryptocurrency has faded. However, in terms of the blockchain technology, it's still kind of at the small level here. We don't think that there's going to be any meaningful change for quite some time here. And that goes to the follow-up question is, if you were to do it, which would it be applied to? And historically, it's always been operational processes. All right, fast forward through the world of blockchain and crypto. Let's look at which, in this current environment, which potential risk is greatest towards financial market stability. And I think one risk that we got to put on here is the pandemic risk to be added now. But in regards to that, we look at geopolitical risk as 14, and we had the risk going on in the Middle East with Russia and Saudi Arabia, and those countries couldn't agree to, OPEC Plus couldn't agree, and so now the price of oil is dropping, which has a tremendous impact on the energy market and its cascading effect. So let's just kind of go down the list here. From an investor standpoint, the Gulf sovereign wealth funds are vulnerable to this because a lot of their income and wealth is from fossil fuels. And so if those countries' budgets can't balance or they can't have a fiscal surplus, they can do one or two things. They can keep raising debt in the fixed income markets, and that's been a strategy. And when the last kind of 2014 oil price decline happened, that's kind of what worked out. But if there were going to be a sustained, prolonged low oil price, we will see shifts in their asset allocation, and we will definitely see a loss of large investment mandates that will probably extend into the next year. And kind of the same exercise happened back in 2014. A lot of mandates were redeemed then. So, and that's going to trickle into the asset management industry, which is already facing a tremendous market forces, right? The asset management industry is kind of bifurcated. You have the traditional asset managers, the fixed income, the bond shops, the traditional equity managers. Their business is getting obliterated in terms of the institutional market, right? A lot of investors are looking towards lower cost products. We just saw BNY Mellon introducing a quote unquote zero cost ETF. I haven't read the fine print, so I don't know. But a lot of the large asset management houses are going towards that model. And even if you look at the SEC filings, you'll see that a lot of large asset owners are actually picking up and buying exchange traded funds, something that you probably wouldn't have seen years and years ago. So that trend is occurring. On the other side of the world of asset management are the private fund managers, the infrastructure managers, the real estate managers, the private equity managers. These managers are having a great time, and they're raising tremendous amounts of money, tremendous amounts of dry powder, and they're still getting a ton of allocations. Just based off our data on SWFI.com, Compass is our RFP opportunity tracker. We're seeing just, everyone's asking for private equity, infrastructure, real assets. It's definitely something that is getting a ton of demand. So going back to this, the potential risk is for financial market stability, geopolitical risks, so that's energy, oil, tension in the Middle East. We had the takeout of the Iranian general, increasing tensions there, and then we had the U.S. Signaling to pull out of Afghanistan, but then in that very same day, U.S. forces took out another, I believe, Taliban patrol unit. So, but I think the geopolitical risk is being overshadowed by this coronavirus outbreak, and that will have a very lasting impact. I had a chat with somebody on the business side of things, not on the investment side of things. And he was saying with a lot of people working from home and working remote, I think companies will see how much personnel they actually really need, right? I mean, so that might have an impact on the labor markets. Going to this other risk that is interest rate increase risk, which for right now, that was the second most popular, but for now, probably the chances of an interest rate increase are very, very low. But if you took out the word increase and just said interest rate risk, that would be a much different, that would change the whole story, because Norway made a killing. If you looked at Norway's asset allocation and a few other sovereign wealth funds that had a large allocation to treasuries on paper, they did quite well, because the Fed keeps lowering these rates, and other countries are doing the same way. So they had quite a decent fixed income return for 2019. Going down here, asking the investors, hey, what do you want to see listed companies do with their cash flow? Do you want them to increase capital spending? Do you want them to improve their balance sheet structure? And that means repaying debt obligations, working on your pension solvency issues, or return cash to shareholders, share buybacks, dividend payments, cash acquisitions. And I remember for about 2 years, the phrase share buybacks was all over the news. People were talking about that. That was occurring. That was a big driver of equity price, was share buybacks. But what these long-term investors really want is they want balance sheet improvement. They want the funds right now to de-risk, look at their debt, try to get better terms on financing, deal with the pension issues that are coming. A lot of the pension issues are actually legacy now. It was a bigger issue about 10 years ago. And, optimizing your operations. And then the increased capital spending, that's always kind of been in line. And that will drive revenue in the long run. But right now, I think a lot of investors are worried about the solvency of many of these companies. Just looking at the, you had Uber IPO, Lyft IPO, all these tech companies, they're still operating where, hey, how much equity is there in terms of, and how long it lasts. I think WeWork was one of the first catalysts to kind of shake the venture capital community and really impact things. And, tying everything in here, what I said earlier was this impact of the coronavirus and the impact of the equity markets is having a negative impact on other asset classes. So venture capital is going to go through a very tough time. SoftBank couldn't launch its Vision Fund 2. It was very lackluster. In fact, SoftBank is mostly backing Vision Fund 2 itself, and it couldn't attract the Gulf capital as it could for the first one. And a lot of these bets aren't panning out. They hired very fast, a lot of high-paid engineers, and the goal was to dominate market share. And with venture capital, you have winners and you have losers, and a lot of these losers are kind of reminiscent of the 1999 bubble. And so if the equity markets can't grow and they're not attractive, there's no exit for the musical chair world of venture capital, right? Because some venture capitalists think, okay, well, I'm backing this startup here. My goal is to get to the next round, and then I get some money out, and then they're going to buy it, and so when you go from venture capital to growth equity to exit, if there's no exit, then that's when panic happens. And so that's going to unfold here. And I think we've already seen wealth funds pull back, and they're being very strategic on these venture deals. So recently, Waymo, which is a Google moonshot. And for those who are not familiar with what a Google moonshot is basically it's one of their concept companies that's trying to transform a certain industry. And actually, a lot of pensions and sovereign funds, they have divisions, what they call them an innovation division or a catalyst division. They can take these bets to kind of fund these vehicles. So Google, they've done it with other companies like Verily, but Waymo is the world of self-driving. CPPIB and Mubadala investment company. Those large investors backed Waymo and provided capital. So we will see startups like those still getting funding, but ones that don't have a very big revolutionary idea, transformative concept, those will probably struggle. Or if they're already heavily invested. So, for example, I just got a note that Magic Leap, which is an augmented reality company, which received sovereign wealth fund capital, and pension capital, they're looking at possibly selling. That's not been confirmed by the company, but that's what some of the major news outlets have been reporting. Magic Leap. It's based out of Plantation, Florida. And so we are starting to see some of those stresses there. Can they make payroll? Do they have a product that the public will want to purchase? And so those stresses will come faster. So let's scroll down here, and the last two areas deal with general asset allocation, and let's just kind of go over some things that kind of popped out. Okay, so one thing that popped out is within the next 12 months in general asset allocation, what do you plan on doing? Interesting enough, I kind of ignore the same because it's just kind of like people check the box. Okay, it's not much change there. I really look at the overweight, underweight, significantly overweight, significantly underweight. That's why I really look at the change, right? So a lot of people are looking at putting money into cash, and that's been seen right now with the treasury yields and all that kind of. So this is becoming reality right here, and that's cash. And then we also see, people getting a bit nervous on credit strategies. Now, private credit has been hot. A lot of wealth funds create their own platforms and partnerships with Bain, with aircraft leasing. You've seen a tremendous amount of U.S. pension funds putting a lot of money into credit. I think there's going to be a lot of distress in that, and so a lot of investors are getting a little bit more cautious on, should I chase these high yield assets? And I think that there will be some kind of distress there. But for the bigger investors that are more contrarian, they might be able to deal with the heat a bit more. Going down here, surprisingly, we see overweight international equities, active global equities overweight. So again, this is before the massive downturn that we saw in March, but a bit of optimism. And so a lot of these investors are contrarian. They might double down and put money later on in there, but that's kind of to really see. And then one that's been very consistent is private infrastructure. In the last probably 10 surveys that we've seen, always overweight private infrastructure, and that is something where investors can't get enough of. And when I talk to sovereign funds, what they tell me is that, hey, I really want to invest in U.S. infrastructure, but where do I start? It's really hard to get in it. And so that's something that we are seeing is that demand. And I believe the UK government under Boris Johnson just put out a huge 5-year plan on infrastructure. I don't know exactly what the split would be open for public and private spending. I believe the private side will be open to energy infrastructure. It'll be open to, I believe, toll roads, I think. The energy side they really want because they're working on decarbonization. The Paris Climate Change Accord is having a major impact on governmental policy, and they want to transition from fossil fuel to offshore wind and solar, et cetera. So there's a tremendous opportunity there, and that's why we're seeing record funds being raised in infrastructure and still having that high demand for private infrastructure. On the other hand, listed infrastructure, people don't really care. It's something that we've always seen underweight. So there is a value for the private markets versus that. Hedge funds kind of tapered out. In the past surveys, everyone was dumping hedge funds. I think people might want to relook them now because there's more volatility now. Hedge funds usually do well when there's tremendous volatility in the market. So whether you want to call them hedge funds, absolute return funds, now the new buzzword is trend following, right? We will see an uptick on that. And there's definitely been a clearing out of funds, but I think a lot of these fund managers will probably dip their toes back into the game as this volatility, tends to, pick up for the rest of 2020. Private equity, again, consistently with private infrastructure, overweight. So there's still tremendous demand for that. And then commodities, people are kind of not saying anything right now, but in the past, everybody was underweighting commodities. So that's kind of the plans on the general asset allocation. Oh, one thing I didn't cover was, the active U.S. equities. That's been swinging back and forth over the years. I mean, over the quarters. And then, smart beta is also one that I did want to highlight. That one, it was really big in 2018, and we've seen a really slow down in the last 2 years. Now, with regard to geographic asset allocation, what are investors looking at doing in the next 12 months? So let's look at this. If we scroll down here, actually they just didn't. I gotta look at this one again. They're the same ones on both sides. Okay. Well, I can't give you the overweights there. I can give you the percentages. Let's see here. Europe, UK, ex-UK, that's been an overweight there. We can also see rest of Asia, and Japan and China. India has been slower, but interestingly enough, though, if you look at the large private transactions through SWFI.com, you look at the large infrastructure deals, the building of credit platforms with, other Indian financial institutions. There's been a tremendous amount of sovereign wealth fund money going into India. So, again, that's kind of a surprise there. And then if we look at scrolling down here, Latin America is definitely having their issues, and then Australia is a market where it is something where it might be a little overheated. We are seeing real estate transactions being done in Australia. A lot of wealth funds like GIC and Asian investors from Singapore and Japan are buying up property across Australia, with Brisbane, Perth, etc. And then another sliver, I know we talked about Asia, is Japan. And we are seeing demand in that, but it's really bifurcated. Because of the stewardship principles, there are more investors wanting to invest in Japan. Corporate governance is slowly getting worked out there. And then you also have the Bank of Japan buying record amounts of exchange traded funds, which is kind of propping up the market. But some investors feel that it's overvalued, and an alternative play would be China, India, and the rest of Asia. In terms of Africa, there is a lot of demand, but it is with select fund managers and select private equity vehicles. For the average pension fund in the U.S. or smaller wealth fund, they're just not going to make an allocation. It'll be very small. And then the last is Latin America, Brazil. Not a lot of interest right now. Investors are very cautious to see how that region plays out. And in the last part of the survey is where we are looking at specific industries that have interest. And remember, the most crowded trade in the first question, information technology, that's where you're going to get a lot of your returns. Pharmaceuticals, we're looking at consumer staples, which probably right now will pick up as the coronavirus subsides. I don't know when. And then utilities. The underweights are energy, and right now energy is terrible. A lot of the shell companies are getting hammered right now, and a lot of the private equity and distressed and credit funds that have funded the shale revolution in the United States, they're not doing so well right now. So let's see how the next quarter plays out, but we will definitely see a lot of distressed hedge funds or players that would want to go out there and see if they can pick up that debt for a lot cheaper. And so let me tie everything up here as I approach the 35-minute mark here, is that there are a lot of headwinds. The coronavirus was a catalyst for a lot of things. I would like to see what the impact on investors have in the next quarter and see if the coronavirus is the biggest concern for them. I also want to see how they're going to change their asset allocation in the next 12 months. Will they keep going towards cash, or will they start to break that money up and try to jump on assets that are falling down? And then the more important issue here is what impact with the markets is going to seed into other asset classes. I mean, will every asset class suffer? What will be the correlation between all the different asset classes? And that's the biggest concern that chief investment officers have is, they're right in this bull market with equities, but how do they protect themselves from when something like this happens? And what we're finding out is that every asset class is kind of being impacted by that. Venture, which again, it's not big enough to really suffice a large investor. I mean, if Norway was to go into venture capital, they're just too big, right? And actually, a lot of the larger sovereign wealth funds, for them to invest in Series A and B, it's just not enough. They have to start going for the more of the vehicles or things like Waymo, where they can actually make a decent return off that due diligence. Anyways, I want to thank everyone for joining this call. We do appreciate everyone taking their time. We will put this up, clean up a little bit. If you do want a copy of the survey, please email support@swfinstitute.org. That's support@swfinstitute.org, and we can give you a copy of the survey. And if you want to learn more about our organization, if you currently are not a subscriber and you want to see if our platform makes sense for you and you want to see how it adds value, because we have a lot of asset owner, manager, bank clients, corporate clients, basically anyone that wants to understand capital, please feel free to reach out to support, and one of our specialists will be happy to give you a demo. I want to thank everyone for giving your time, and you have a wonderful day, and thank you. Bye.